Imagine a man who built a $100 billion empire without ever inventing a product, discovering a tech breakthrough, or creating a retail franchise. He didn't build a factory, write software, or strike oil. Instead, he sat in a quiet room in the American Midwest, reading pages of dry financial data, day after day, for 3/4 of a century. In a world obsessed with speed, insider secrets, and overnight millions, Warren Buffett did something far more radical. He waited longer than almost anyone else was willing to. He bought small pieces of boring, unglamorous businesses and let time do the heavy lifting. But the story we think we know, the folksy billionaire who drinks cherry Coke and eats McDonald's breakfast, misses the real truth. His wealth was not an accident of birth or a stroke of blind luck. It was the result of an extraordinarily disciplined system built by an obsessive and highly analytical mind before he even hit puberty. This is the story of how Warren Buffett actually got rich. To understand the billionaire, you have to understand the kid who was deeply shaped by the Great Depression. Born in 1930, Warren Buffett was the son of Howard Buffett, a local stockbroker who lost his job when the banks collapsed. Security vanished overnight. For young Warren, financial independence became an early consuming obsession. He didn't just want money, he wanted a shield against vulnerability. By age 6, while other kids were playing baseball, Warren was a micro-entrepreneur. He bought 6 packs of Coca-Cola bottles from his grandfather's grocery store for 25 cents and sold them individually to neighbors for a nickel each, netting a 20% profit margin. He delivered multiple newspaper routes, sold used golf balls, and installed pinball machines in local barbershops under the name the Wilson Coin-Operated Machine Company. He wasn't just hoarding cash, he was obsessed with the concept of capital efficiency. Every penny earned was a soldier designed to go out and capture more pennies. In 1942, at just 11 years old, Warren took his first major leap into Wall Street. Using $114 of his own hard-earned savings, he bought 3 shares of Citi's Service Preferred for himself and 3 for his sister Doris. He bought it at $38 a share. Almost immediately, the market plunged, and the stock dropped nearly 30% to $27. Doris reminded him of the loss every day on the way to school. Anxious but determined, Warren held on. When the stock finally recovered to $40, he sold immediately to lock in a modest profit. He felt a wave of relief. But then the market did what the market does. Shortly after Warren sold his shares, Citi's Service Preferred skyrocketed, eventually soaring to over $200 per share. Had he simply done nothing, his tiny investment would have quintupled. This was Warren Buffett's first and perhaps most vital investing lesson. Never panic sell. Don't obsess over small short-term profits. And above all, realize that patience is the ultimate competitive advantage. By the time Buffett entered college, he had amassed thousands of dollars from his childhood businesses, but he lacked a cohesive philosophy. He was still trying to predict chart patterns and time the market, a strategy he later compared to astrology. Then, at 19, he picked up a newly published book called The Intelligent Investor by a Columbia University professor named Benjamin Graham. Buffett later remarked that reading it was like seeing the light.
19 years old in Lincoln, Nebraska, and I picked up a copy of The Intelligent Investor. It not only changed my investment philosophy, it really changed my whole life.
He immediately packed his bags and went to study directly under Graham at Columbia Business School. Graham's philosophy, known as value investing, stripped the emotion out of Wall Street. It rested on 2 foundational pillars. First, a stock is not a lottery ticket. It is a fractional piece of a real underlying business. If the business is worth more than its current stock price, buying it provides a margin of safety. Second, Graham introduced the allegory of Mr. Market. Graham taught Buffett that you don't argue with Mr. Market, and you don't let him dictate your emotions. You simply exploit his mood swings. Buffett became Graham's standout student, later recalling that Graham had given him one of the few A-plus grades he ever awarded. He hunted for what Graham called cigar butts, beaten down, unloved companies whose stock prices were so cheap that they were selling for less than their net liquidation value. They were like discarded cigar butts found on the street, soggy and unappealing, but capable of giving you one free puff of profit. In 1956, at age 25, Warren Buffett returned to Omaha. He had worked briefly on Wall Street for Graham, but he despised the noise of New York. He preferred isolation, away from the herd mentality of the financial capital. With $105,000 gathered from 7 limited partners, mostly family and close friends, and contributing just $100 of his own money, he launched Buffett Partnership Limited. The terms he set were revolutionary. He charged 0 management fees. He only got paid if he generated returns above a 6% cumulative hurdle rate. If the fund lost money, Buffett would personally absorb a percentage of the losses. It was an absolute alignment of interest. Operating out of his bedroom, Buffett began scouring the financial manuals, manually turning thousands of pages in Moody's and Standard & Poor's guides to find deeply undervalued microcap stocks. What followed remains one of the most astonishing streaks in investment history. Between 1957 and 1969, the Dow Jones Industrial Average returned roughly 7 to 8% annually. Buffett Partnership Limited generated average annual gains of approximately 29.5% before fees, and about 23 to 24% after fees to partners. A $10,000 investment in his partnership at inception would have grown to over $150,000 in just 12 years. Buffett's own personal wealth exploded. By 1962, at age 31, the boy who had sold Coca-Cola bottles door to door was officially a millionaire. But just as he reached this milestone, the market began to shift. The late 1960s brought a roaring bull market fueled by speculative go-go funds and overvalued conglomerates. Buffett looked around and realized he could no longer find cheap stocks that met his strict criteria. Rather than compromise his principles or risk his partner's capital in a speculative bubble, Buffett did something unheard of on Wall Street. In 1969, he dissolved the partnership entirely, returned the cash to his investors, and walked away from the game. Well, almost entirely. He held on to one strange failing asset. That asset was a declining New England textile manufacturer called Berkshire Hathaway. Buffett had started buying its shares in 1962 because it was a classic Benjamin Graham cigar butt. The business was dying due to cheap foreign competition, but the stock was trading at $7.50 per share, while the company's net current assets were worth significantly more. It was statistically cheaper alive than dead. In 1964, the company's president, Seabury Stanton, made an oral agreement to buy back Buffett's shares for $11.50 apiece. Buffett agreed, but when the official written tender offer arrived in the mail weeks later, Stanton had undercut him by 1/8 of a point, offering only $11.37.5. It was a tiny difference, but to Warren Buffett, it was an insult. Enraged by Stanton's bad faith, Buffett didn't sell. Instead, he did the exact opposite. He went on an aggressive buying spree, purchased controlling interest in Berkshire Hathaway, took over the company, and promptly fired Seabury Stanton. It was a total emotional victory and a colossal financial blunder. Buffett had trapped a massive portion of his capital in a doomed capital-intensive textile business. He spent years attempting to keep the textile operation alive before finally shutting the mills down in 1985. Buffett would later describe the textile purchase as one of his biggest investing mistakes, estimating that the long-term opportunity cost reached into the tens of billions of dollars.
The dumbest stock I ever bought was, drum roll here, Berkshire Hathaway.
But Berkshire Hathaway could also become the foundation of his future success, thanks to a profound shift in his philosophy prompted by a new partner, a brilliant, razor-sharp lawyer turned investor named Charlie Munger. Munger convinced Buffett to break away from Benjamin Graham's cigar butt strategy. Munger famously summarized his philosophy by saying, "A great business at a fair price is superior to a fair business at a great price." Instead of buying dying companies because they were cheap, they would look for exceptional companies with durable competitive advantages, what they called a moat. To pivot away from textiles, Buffett needed capital, and he found the ultimate financial engine in a completely different industry: insurance. In 1967, Berkshire Hathaway acquired National Indemnity Company for $80.6 million. Later, they would acquire GEICO. Buffett realized that insurance companies possess a unique structural advantage that most businesses can only dream of: float. Insurance companies collect premiums up front, but they often don't pay out claims until much later. That money sitting in between, the float, can be invested. In the hands of an average corporate executive, insurance float is often mismanaged or invested in low-yield bonds. But in the hands of Warren Buffett, it became an economic superpower. It functioned almost like a massive pool of low-cost investment capital. He took this money and used it to buy entire businesses that had massive economic moats, brands so strong that consumers would fight before switching to a competitor. Consider his 1972 acquisition of See's Candies. Buffett and Munger bought the California chocolate maker for $25 million. It was a business that required very little capital to run, but possessed immense brand loyalty. See's could raise the price of its boxed chocolates every single year before the holidays, and loyal customers wouldn't blink. The cash generated by See's Candies was funneled directly back into Berkshire's insurance engine, which was then used to buy massive stakes in companies like Coca-Cola and American Express. The wheel kept turning, bigger and faster, year after year. This brings us to the absolute core of Warren Buffett's wealth, the secret that most investors understand intellectually but fail to practice emotionally: compounding. Compounding is not linear, it is exponential. It is a mathematical snowball that starts small but expands aggressively the longer it rolls. By most estimates, the vast majority of Buffett's wealth was accumulated after age 50, illustrating the extraordinary power of long-term compounding. By age 30, Buffett was already worth around $1 million. By age 50, that had grown to roughly $300 million. By age 60, it had reached billions, and eventually, through decades of uninterrupted compounding, his net worth crossed $100 billion. Why did this happen? It wasn't because his investment returns got better as he aged. In fact, his highest percentage returns were achieved in his 20s and 30s. The explosion of his wealth happened simply because he kept his money compounding, uninterrupted for more than 70 years. Most investors get tired, panic during a downturn, or cash out to buy yachts and mansions. Buffett never stopped. He treated Berkshire Hathaway as a permanent compounding vehicle. He never paid out a dividend to shareholders, preferring to reinvest every dollar of profit back into the machine. He lived in the same modest Omaha house he bought in 1958 for $31,500. He drove his own car. His lifestyle didn't scale with his wealth. His compounding engine did. When we look at the legacy of Warren Buffett, it's easy to focus on the stunning numbers, the massive corporate acquisitions, or the legendary annual shareholder meetings in Omaha. But the real blueprint of his wealth is far more accessible than that. It is a testament to what happens when an individual identifies their core strengths early, aligns with their incentives perfectly, masters their own emotional impulses, and refuses to let the noise of the world interrupt the compounding process. Protect your margin of safety. Exploit the mood swings of the market. Acquire businesses with structural moats, and let time do the heavy lifting. He didn't beat the system by being faster than everyone else. He beat the system by being willing to go slower than everyone else. In a world chasing the next quick win, the ultimate lesson of Warren Buffett is that true financial freedom isn't built overnight. It is accumulated dollar by dollar, choice by choice, through the quiet, relentless power of time.